Our next guest releasing a new note, changing his stance on equities and cash. For more, we're bringing in now Keith Lerner. He is co-chief investment officer and chief market strategist at Truist. Keith, it is always great to see you. So let's talk about this new note, Keith, because you tell your clients you downgrade equities to neutral, Keith. So you're officially lukewarm. Explain why, Keith. What are the reasons?
Yeah, well, great to be with you all. Well, as you all know, we've been big bulls over the last year. And when we look at the weight of the evidence in our work, it suggests a more mixed backdrop. And we're making that adjustment to reflect that. And as I talk about the weight of the evidence, there's a couple of things that we're looking at. And you all have discussed a bit of this. One thing is the economy. We still think the economy it will be somewhat resilient, but we're certainly seeing some softness. You can look at the economic surprise index, which is now at the lowest level since September. You mentioned consumer confidence, weak service numbers last week. So again, I think we're going through a little bit of a soft patch, which is kind of the buzzword, I guess, this week. So that's number one. The next thing that we're looking at is forward earning estimates for the S&P 500. A pillar of this bull market, as we've discussed in the past, has been the earnings have been really resilient. Well, what we've noticed over the last month now, forward earning estimates for the S&P 500 have started to flatline. Again, that's not catastrophic, but it is a shift in that trend. And then thirdly, when we look at the technical side of the market, the price trends, what you see is a very split market. Only about 50 to 60% of stocks are actually in uptrends defined by above the 50 or 200-day moving average. You put that all together ahead of some event risk and the Fed being on the sidelines and some fiscal tightening, to us, it's prudent to at least make some shift in a risk exposure.
So Keith, for people, we have strategists like you come on all the time. You talk about being overweight or neutral or underweight stocks. And just for the people who are watching at home, right, who are retail investors, it doesn't mean sell stocks. It's neutral relative to what, right? Does it mean like you should keep a sort of conventional 40% bonds, 60% stocks in your portfolio? Like, what does neutral mean actually in terms of positioning?
No, I love your question. It's the right one. And because a lot of times, we have strategists, it's like these really big, bold calls. But the reality is, each client has a different benchmark. Some of them are going to be much more aggressive. Some of them are going to be more balanced, like you said. So basically what we're saying is relative to our benchmark, let's just say it's a 50% stocks, 50% bonds. Over the last year, we've had an overweight or more money relative to that benchmark weight in equities. What we're saying is right now, we're above that benchmark. We want to bring back our equity exposure back down towards benchmark. We're not saying this is time to panic. We're not saying this is the time to have 50% cash. But we are saying is that we expect it to be a little bit of a bumpier path. We expect that there's going to be some disruptions along the way this year. That was actually part of our outlook coming into the year. So maybe shaving some of that off and then having a little bit of cash when we see some of these disruptions. And so far, we're only still about 2 or 3% from an all-time high. So we think this kind of corrective choppy period likely has further to go.
Let me ask you, Keith, when you downgraded equities to neutral, you must have been thinking through, okay, well, how could I be wrong? What are the upside risks to my call? So walk us through that.
Yeah, no, as a strategist, I mean, there's no certainties in what we do. That's why we say weight of the evidence. And so what could go well? Well, I think in some ways we're starting to reset those high expectations right now, right? The buzzword, as I mentioned, is soft patch. No one was talking about a soft patch 2 weeks ago. Obviously, we have the big print that you discussed before with Nvidia. That's going to be a big thing in near term. And also, if the administration starts talking back some of the tariffs, that could be a little bit of a relief rally as well. And then also, I mean, maybe in a week or two, some of the soft patch in the economic data actually starts to reaccelerate, or the earning trends start to move up again. So those are all things we're looking at. But again, we're looking at the way of the evidence, and I kind of laid out the picture that at least the things in our work have changed. And again, going back to an important point too is, normally if the economy was going to show a little bit of softness, people would start thinking, hey, the Fed's going to start cutting rates. Maybe they're going to start moving a little bit quicker. But they're basically boxed in our view because of the tariffs. And the only way they'll cut more aggressively than mid-year is if the economy really starts to slow down, which we don't want to see from an equity standpoint.
Keith, it's really interesting that the recent crop of data that you're referring to, the soft patch you're referring to, and the vibe shift that we have seen. I mean, it was last week that we were at new highs, right? So and it feels like things have shifted kind of quickly. And even when we were at new highs, the underlying sentiment did not seem to be great. What has changed? What is going on here? And you know, how do you see that further evolving?
Yeah, in our view, when we were making those new highs, as I mentioned, below the surface, actually, there was only about a half the stocks participating. So even though the headline index made a new all-time high, beneath the surface, you weren't as strong. And you also saw things like small caps actually somewhat weaker. I think right now investors are having a difficult time digesting the frenetic pace from Washington. Again, not from a political standpoint, but like, what does this mean? And what you're seeing in some of the confidence numbers is there's just more uncertainty. And since you had a string of 2, 3, 4 economic reports that were somewhat weaker, I think that's changed people's views somewhat. Now, also, you have to think about this. It's not like the economy is falling apart, but expectations coming into this year, the average economist was expecting U.S. GDP growth well above 2%. In contrast, coming into last year, the expectation was only for 1% economic growth last year. So that bar for positive surprises was really low. And we winded up last year growing, closer to 2.5%. So this year, I think the main difference is that bar for positive surprises was set higher, and we're seeing some modest deterioration relative to those more elevated expectations. And what we're seeing right now is a reset of that. And by the way, the S&P 500 is basically back to where it was the day after the election.
Yeah, indeed it is. Keith, thank you so much. We'll see what continues to happen from here. Appreciate it.
Yeah, thank you.